Where's the little button down here? There it goes. Good evening. I am very sorry that I am about 25 or so minutes late. I was having technical difficulty accessing the site, and I apologize for the delay. We will get to our first two chapters tonight. Excuse me, I'm getting all tongue-tied. Using securities markets for financing and investment opportunities. And then we will, this is chapter 19, and then we will conclude with chapter 20, which talks about money and the Federal Reserve, among other things. So let's look at our learning goals for this evening for chapter 19. Describe the role of securities markets and investment bankers. Identify the stock exchanges where securities are traded. Compare the advantages and disadvantages of equity financing, which would be issuing stock, as it says there, and detail the difference between common and preferred stock. Common is the most ordinary stock that you have. Compare the advantages and disadvantages of obtaining debt financing by issuing bonds and identifying the classes and features of bonds. And then the following ones explain how to invest in security markets, look at long-term growth, income, cash, protection from inflation, analyze opportunities stocks offer as investments, opportunities bonds offer as investments, explain the investment opportunities of mutual funds and the exchange traded funds, and then describe how indicators like the Dow Jones Industrial Average affect the market. So let's get into some of the slides here this evening, and we'll talk a little bit about this very interesting securities markets. Markets, you remember, are places where buyers and sellers meet, and we need to remember that markets don't necessarily mean a physical place. And in fact, most stocks and bonds today are traded over the internet, and that has really changed the way investment is done today. There are many large firms that really affect investment and how stocks move and how they move, and even bonds move, but more stocks, how they move and how they change the investment arena, I think, is the best way to go. So stocks and bonds serve two primary functions. They assist the investor or a business trying to raise funds. They assist those people in gaining capital funds to move the business forward. And then they provide people like you and me, what we're known as private investors, to buy securities, stocks and bonds, and how to use those to help in some way move forward. Now, these are the types of securities that we talk about. Primary markets handle the sale of new securities, and secondary markets handle the trading of securities between investors like us, with the proceeds of the sale going to the seller. Now, many times the seller is an individual, sometimes the seller is an institution, sometimes the seller is something else. And then we have what is known as an initial public offering. This is the first time a company, and I'm using the term company instead of corporation here, a company's stock is offered. You may have paid attention recently to Facebook just had an initial public offering, and there's been some other ones that you may have been exposed to during some of the recent pieces in the news. But Facebook is probably the one that most of us would know. Now, what happens in this is that Facebook stock had never been offered before. It had either been a privately held company or it just had not issued stock. Most likely it was a little both, privately held and then not issued stock. People want to get in on the ground floor of this, and so they will try to start jockeying for what they think the initial public stock offering ought to be. Facebook's initial public offering came in at around $38. Please don't hold me to that, but it was somewhere in that neighborhood. And for some strange reason, it went on to NASDAQ, and we'll talk about NASDAQ a little bit later here in the lecture of this evening. For some peculiar reason, there was a technical glitch in what NASDAQ did, and it caused the stock to drop in value quickly. And there were some other problems with the initial public offering. It caused a lot of problems with Facebook and NASDAQ, and investors lost a little bit of money on it as well. But I think that's all been gotten back together. Now we have a couple of type of investment people. One is an investment banker, and the other are institutional investors. Let's do institutional investors first. These are large institutions. The largest one institutional investor, I don't know if institution really falls to them or not, but the largest investor that I know that would fall into an institution is CalPERS. CalPERS is the California Retirement System, and it owns a lot of stock, a lot of shares in stock, etc. And it will invest its funds for the members who are in the California retirement system, pension system, to try to continue to earn money so they have money in that system pay out to people who when they retire. Now there's a real problem with that, and the reason not with CalPERS, but there's a real problem with this, that many public companies and investment outfits, institutional investors, have pension funds that are not fully funded. In other words, what that means is that they're supposed to be able to pay out, I'm going to use a figure here now, $10 billion over a period of time, and they don't have anywhere near $10 billion in their coffers to pay that money out. The Kentucky retirement system has been plagued with problems here in the last few years. I'm interested in that. I'm a Kentucky resident. I have a son who's in that system. He's a high school teacher. So I do think about that. There's been a problem with that. It's not fully funded, and the state legislature has been grappling with ways to fix this. Now, investment bankers are a little bit different. They're not like our normal bankers. Some banks have investment banking arms. There would be big banks, huge banks like Citibank or Chase, Morgan Stanley Chase. I'm not sure if it's Chase Stanley Morgan or what. And then Chase Manhattan's another large one. Certainly Wells Fargo would be one. Bank of America would be another. But they help organizations, companies, in the issuing and sale of new stock, new securities. And I said stock, and I should not limit myself to stock. It can be bonds as well. So what I should have said is investment instruments. These are the stock exchanges. We're going to talk about them. This is where members, and you have to be a member to be able to buy and sell. So if I want to buy stock, I have to go through a member of one of these stock exchanges who has who pays a fee to have a seat on the stock exchange, and that way I can buy and sell a stock. You can go through mutual companies, you can go through stock companies. That's what they do. You can go through different members on the stock exchange. So they sell them. Notice they buy and sell securities for individuals like us, or for companies, or for other types of investors. The over-the-market counter is a little bit different than the New York Stock Exchange, which we're going to talk about in a minute, and NASDAQ, which comes next. And here, stocks are traded, as it were, over the counter, because these stocks are not listed on one of the national stock exchanges, either NASDAQ or the New York Stock Exchange. Do not think because these are over-the-counter stocks that they do not have value and that they are not secure. That does not mean that they're not. It's just that they're not listed. You have to pay to be listed, and they may not want to be listed. They may not be big enough to be listed. The New York Stock Exchange requires a company to be a certain size, and its value, the value of its stock and the value of the company, to be a certain amount. Otherwise, they will not list it. NASDAQ is a completely computerized system. And notice it says it's a telecommunications network linking dealers across the country so they can exchange securities electronically. Now, it's not to say the New York Stock Exchange does not do that. It does. But the New York Stock Exchange actively has traders on the floor. These are the top exchanges. I refer to the New York Stock Exchange. It is actually, as the slide says here, NYSE, New York Stock Exchange, Euronet. They combined several years ago, and so that's what you have the NASDAQ. Here you also have shown as the London Stock Exchange, known as the FTSE, FTSE, Financial Times Securities Exchange. The Tokyo Stock Exchange, and I apologize, I don't remember the name for the Tokyo Stock Exchange. The Deutsche Börse, that's German. The CAC 40 is the French Stock Exchange. Now, this particular slide is the focus on small business, which you see in in your text. And what this says is that since we went through and we're still coming out of, I like to say, it's the financial crisis that started in late 2007 and blossomed in 2008, 2009, many small businesses are having difficulty getting financing. Notice that this gentleman here believes that there should be a new stock exchange that cater to small companies and help small companies raise capital. A lot of people feel that way. There's been a lot of complaint about the New York Stock Exchange and perhaps even NASDAQ. I'm not going to speak about the Europeans because I don't know as much about them, but they really are paying more attention to the large people and not to the small guys. And now there is if you're into mutual funds, there's many mutual funds that talk about small cap and they invest in small companies. But that does not mean that the small company itself is small company stock. The small companies are actually being able to get financing. Now, this is really talking more about not established small companies, companies that just start, companies that are trying to grow, etc. So this isn't a new idea in the United States. Notice that China has something similar today. Securities and Exchange Commission was created in 1934 by an act of Congress, and it was in somewhat respect a response to the depression that started in October 1929. The Securities and Exchange Commission is a watchdog agency. Companies that are publicly traded have to provide the Securities and Exchange Commission with certain reports normally on a quarterly basis. And then they also must do this prospectus, which is next. A prospectus comes in two ways, and I'll explain the two here. What this says, a version of the economic condition of a company. By the way, these are publicly traded companies. If a company is privately owned, it does not have to do this. It does not have to follow the rules laid down by the Securities and Exchange Commission. Securities and Exchange Commission only applies to publicly traded stocks and bonds, not to things that are corporate, that are privately held. So anyway, they must file this information with the Securities and Exchange Commission before issuing stock. And even if they have issued stock, if somebody else is interested in buying stock, a new investor, the company has to send that person a prospectus. And that prospectus mostly talks about the stock itself and what its returns have been. One of the things that always has to be placed in that is the following, and that is past performance is not an indicator of future performance. Now, we're going to give a little bit of a lesson here, I hope, to those of us who are not real well informed about the stock market. And I would tell you that most people, even if they're investors in the stock market, the average person probably doesn't know as much as he or she should know. And so what I say to you now is, if you're interested in investing in the stock market, there are two things that you need to keep in mind. And I might repeat this later in tonight's lecture. The first one is, you only get into the stock market if you're in for the long term. Now, there's a caveat to that. Obviously, if you have a lot of money, and I'm talking in millions and millions and millions of dollars, where you can afford to buy a certain amount of stock, and then hundreds of thousands of shares, and then if the price rises $1, sell that stock and take your profits. That's fine. Most of us cannot afford to do that, so we get into the stock market either by buying stock directly or through mutual funds. And you need to think about being in it for the long term. You also need to remember that stocks are not financially backed by the United States government. If you have a bank account, certificate of deposit, anything like that, you know that money is insured. Stocks don't fall into that category. The same way with bonds don't fall in that category unless they're government bonds. So first thing is, if you get into the stock market, you should think about being in it for the long haul, not for a short period of time. I'll use myself as an example. My wife and I did not get in the stock market for many, many, many years. And we have been in the stock market for about 25 years. And most everything that we have ever bought, we continue to buy and we continue to hold. Now, everybody doesn't fall into my category. I understand that. But that's the philosophy that you should have if you get into the stock market. The second thing is, the part of the philosophy, maybe third or fourth or fifth, I don't know how many points I've tried to make here. But the second big thing is, don't panic. Stocks go up and down all the time. And if you have to have a certain amount of willpower to be in the stock market, to say I'm going to stay with it over time, and I'll continue to do investing, etc. That's the best game plan that you can have. The third thing is, and this is making the other points I made, is that you need to ask yourself before you get it, how much risk can I tolerate? If I'm risk adverse, in other words, I don't want to take risk, I shouldn't be in the stock market. And there's nothing wrong with that. There's a lot of people not in the stock market. So if you're risk adverse, you don't do that. If you get in the stock market and as you're in it for a little bit of time, you want to change your risk, there's ways to do that. And so you would need to investigate that and do as much as possible. If you have, and I hope you have looked at the video, or you will look at the video about Morningstar. Morningstar is a great resource because Morningstar is set up to assist the individual investor. It is not set up to assist companies selling their stock. It tells the investor, does the research. And you can go to Morningstar.com. There may be a charge for what they do, and I really don't remember that. But Morningstar gives you unvarnished information because it is not backed by any company. So that little preamble out of the way, we talk about a stock. Those are shares and say that you are an owner in the company. A stock certificate, and I'll come back to this in a second, if you have one, hold it up and say, that's proof that I'm an owner of this company. What you will find today is that most people do not get stock certificates. They get a note from the issuer that says Sam Jones owns 25 shares of this particular stock. And then, that's what you use to determine if you intend to sell the stock or get out of it and change it to something else. My wife and I have had Coca-Cola stock for a number of years. We do have some certificates of Coca-Cola stock, but not any longer. Any other investment we make in Coca-Cola, we no longer get stock. The other companies that we own stock in, we do not have any certificate that says we own a share of stock. Those certificates are held by an investment company in our name, and we want to cash in, and we go back to them and say that's what I'm going to do. Now, every company, let me stop and say this right off the bat. Every company that issues stock does not pay a dividend, and there is no requirement to pay a dividend. We learned that sometime before. So some companies don't pay dividends. Some companies pay very small dividends. Some companies pay larger dividends. So if you're interested in dividend, you need to do your homework and find out what type of stock you can buy and how much it's going to cost you and what type of dividend you might be able to earn. So dividends are paid after tax is paid, and they're part of the company's profit. And they are either distributed as additional shares or as cash. Now, you can do one of two things. You can sign up with the company that you own stock in and say, I want my dividend to go to buy more stock. You can do that. Or you can take it, as I said, you can take it in cash. Now, companies issue stock, but there has to be some advantage to that. Well, first of all, we have to remember that the stockholder is a company owner. And even though they're an owner, their investment never has to be repaid. So if I buy, Apple is selling at around $600 a share. I think it's less than that, but I don't remember exactly where it is, 580 something maybe. So if I buy a share of Apple stock for $580, and that goes down in value, say 500, and I decide that I want to sell that one share of stock, and I've lost 80 whatever dollars it happens to be, plus maybe a commission that I have to pay for selling. So But if I hold that and the company goes bankrupt, I never have to be repaid that, the original $580. No obligation to pay dividends, repeating a point I just made. And remember that this can help a company's bottom line, because when they issue stock, and that's purchased, that does not increase debt. It means the company's bringing in more money by issuing stock. Now, of course, there's some downsides to that, but there are usually many more upsides to it than there are downsides. And here are the downsides of issuing stock. Stockholders have the right to vote for the board of directors. Now, that may sound like that's holding a hammer over the company's head, but for the most part, members of the board are reelected. Now, there's been a lot of stockholder revolt. That's a word that I'm using. It's a little bit of a strong word. They've been going after some companies recently and saying, wait a minute, these directors have not received a sufficient number of votes. They need to be off the board. Companies don't have to pay attention to that, but there's been a lot of that going on lately. So obviously, if you issue more shares, that's going to change the ownership of the company. And even though some people will have a lot of shares, they may not be the majority stockholder, but they can cause the board of directors to take a new direction. And I'll give you an example. There's a gentleman by the name of William Ackerman who owns a hedge fund company, and his company bought a large number of shares of Procter & Gamble stock. From the beginning, Ackerman was saying that Procter & Gamble has not been returning a good value to its investors, and so he wanted the board to be broken up, and they wanted the board to be changed, and it was after the CEO, et cetera, et cetera. Well, I don't know whether you want to say Ackerman was successful or not, but the CEO did resign. So I don't think that Procter & Gamble's stock has gone up appreciably since then. But this is what happens when not only issuing new stock, but other people come in and buy more stock and they become a larger stockholder. It can change the dynamics. We said this before, dividends are paid after taxes and they're not tax deductible. That we did not see. And yes, because you need to keep stockholders happy, it may cause the management decisions to have a little problems. Two classes of stock. We've talked about this a little bit before. A common stock, which is the most numerous, actually says the most basic, but there are more shares of common stock, not necessarily outstanding, but being held by stockholders than there are preferred stockholders. They do have the right to vote for election to the board of directors, and there's a few other things that they get to vote on. And they will share in profits if dividends are approved. Now, the preferred stockholders, kind of what it says, they have a preference on the payment of the company dividends. They are first in line before any common stock dividends are paid. The preferred stock can also be callable, can be convertible, and can be cumulative. Now, the next thing we're going to go to is we talked about stocks. We're going to talk about bonds. This is in that we're not talking here about government bonds, but it follows pretty much the same principle. Corporate certificate that says Mr. or Mrs. Jones has lent the company money. Same way with the government. If you buy government bonds, savings bonds, the principal of the bond is its face value. So if you buy a bond for $1,000, that's the principal. But you've lent money. And if you borrowed money, you know that you had to pay interest. Well, this is the same thing, because here a company or the government is borrowing money. It's borrowing an investor's money. And so it says to the investor, we're going to borrow this money from you, and for the consideration of using your money, we're going to pay you a certain percent of interest over a certain period of time. So here the payment the bond issuer makes the bondholders to compensate them for holding their money. Now, if you buy, I think it's Series EE bonds today, the life of that bond is 30 years. You will get the full face value from the United States government after 30 years. Now, you can cash that bond in at a certain amount of time, and you will get varying amounts of money on the bond depending upon how long you've had it there. If you hold it for the entire time, you'll get the entire amount of money back. The last I knew, if you wanted to buy a $100 bond, it cost you $50. At the end of 30 years, you're going to get your $50 back plus an additional $50. I'm not going to try to figure the interest on that, but you can see it's fairly low. Bonds used to be 10 years. They changed this to 30 years. I'm not sure exactly when they changed it to 30 years. But remember, a bond is a debt. Now, here's an advantage of issuing. There are advantages. Of course, we're going to talk about disadvantages shortly as well. Advantages of issuing bonds is that the bondholder is not a creditor. They are not an owner of the firm, and they can't vote on corporate matters. So they can't come in and tell you, you need to start doing this to run your company. Stockholder can do that, especially if the stockholder has enough stock that make him or her very important. The interest on the bonds is tax deductible, so you can take that off on the income tax. Bonds are a temporary source of funding, but again, they have to be repaid at a certain time. They also can be paid before the deadline or maturity date if they contain a call provision. And of course, that would be to the advantage of the company issuing the bonds, because then they can get them back sooner. Well, with every advantage, there has to be a disadvantage. And bond, remember, is a debt, and therefore issuing more bonds can certainly increase the debt, and it can cause people in the marketplace to be concerned about a company's financial stability, because again, bonds are debt. You have to pay the interest on the bonds. That's a legal obligation. You can't shirk that duty. That's required. If you don't pay the interest, then the bondholders can take you to court, and the face value has to be paid when the bond is due. Now, what we're going to show here is a slide that shows bond ratings, and I'm going to give you a caveat about this. This is just the three major rating agencies in the United States: Moody's, Standard & Poor's, that's S&P, and Fitch. And you can see these. I'm not going to go over these. Obviously, the higher up you are, the better you are. One of the contentions is that these rating agencies had been giving banks and other investment firms high marks during the right before the financial meltdown that began in early or late 2007. So there's been some complaint about how well the bond rating agencies are doing things, because they not only rate bonds, but they rate stocks, and they rate banks, and they rate a few other things. So there's been some concern about that. Whatever's going to happen, a little difficult to talk about. We have different classes of bonds. An unsecured bond is a bond that's bought without any collateral. There's no backing to the bond. So it's kind of like a gentleman's agreement or a lady's agreement that I'll buy the bond, and I'm not going to put anything up to back that bond. I'm going to sell a bond, and somebody's going to buy it, but I'm not going to put anything up. Secured bond is exactly the opposite. It is backed by something, usually land or equipment. Some special features of bonds. One's a sinking fund. There's a reserve account set up to ensure there's enough money that will be available to pay the bondholders at the maturity date. Callable, but we already talked about. And a convertible bond allows the bondholder to convert the bond to stock, shares of common stock. Now, we want to buy some stock. So we normally will go through a stockbroker or someone who is registered to sell securities. He or she may not be called a stockbroker, but they're registered with the Securities and Exchange Commission to sell securities, bonds and stocks. Many people will not go through that. By the way, financial planners usually fall into this category of someone who's registered to sell investments. Some people won't do that. They'll work with mutual fund companies, which I'll talk about a little bit later. But those companies are registered to sell securities. So stockbrokers are securities. I'm staying away from stockbroker, only using securities because they sell both. Stockbrokers normally sell both too, but we normally think of them as selling stock. Notice that they're a market intermediary, and we've talked about market intermediaries before. They're a person who brings the buyer and the seller together to make a deal. Here's some online trading services. TD Ameritrade and E-Trade. They offer this. I would tell you only as a cautionary thing, before you get involved in this, please know something about buying and selling securities. This is a ethical, making ethical decisions, money going up in smoke. I always encourage you to read these. You don't have to, but it does tell you something. It gives you some kind of an idea, helps you with the decision-making process. Now, these are investment criteria, and these are laid out for you to think about. Risk. What's the risk of the the risk of the investment? What is the investment going to return, and how soon is it going to return it? That's yield. The duration that you have to hold the security or the investment before you're going to get your money back, plus dividends or something else. Its liquidity, how quickly can it be turned into cash, and what are the tax consequences? All things that need to be considered before you do that. Little thing here called Investing 101. I've tried to mention some of this as we've gone through. So taking an investment class. A lot of community colleges offer these type classes to take. Sometimes local businesses will do that. Sometimes chambers of commerce will. They're around. You can look at the internet and they will help you. Talks about attending a conference. Go to the library. A lot of books are at the library you can use, including these particular books. The myth of the rational market. I like to talk about that because we heard that very often. The rational market won't do things. Markets always act rationally. Well, the fact of the matter is, markets probably do act rationally, but it's people that operate markets, and people don't always operate rationally. This just gives you an idea of return since 1926. If you're doing the math, that's 88 years ago. Small company stocks will return 12.2% over that time, whereas Treasury bills, that's government bonds, and then long-term government bonds are a little less than 6% and 4.1%. And then it talks about large company stocks and corporate bonds. This is something that you should do. I'm not going to go through the percentages that they have here, but every investor, no matter who he or she is, if they're going to start making bigger investments rather than just the bank. And of course, the problem with the bank today is the banks don't pay a very good interest rate, so you can't keep all your money tied up there because you won't make much money. Diversify. You should have some money that you can readily get. That's out of a bank account. Maybe some money in government bonds, maybe some money in stocks that pay dividends, maybe an international mutual fund, et cetera, et cetera. So you want to look at different strategies. You can do this yourself, and you don't need a financial planner. Make sure that you understand what you're doing. I advise people who want to get into something like this to talk to a mutual fund, because a mutual fund, the object of a mutual fund is you have a lot of investors, and so the pain is spread out over a long period of time, or over a larger amount of people. The gain is too, so sometimes you won't gain as much, but there's a little bit more comfort in having a number of people there together. You don't have to do that, but if you do go to a financial planner, make sure that that person has done the training he or she is supposed to do. This particular slide is just, like I like to say, is a gee whiz slide at looking about investing beyond our borders. There are some good investments. Make sure that you are wise about any of those types of investments. Primary investor services, and this is where consumers need savings and interest advice, 401k plans, retirement planning, tax planning, estate planning, etc. Big one here on the bottom, education expense plan. Perceptions of the market. If there's a bull market, or people tell you there's a bull market, that's when there's a continued rise in stock prices. And bulls are people who believe that the market is going to go up. Bears are just the reverse. These are bear market declines, and we've had them. Look at the time period just recently, 2007 to 2009. S&P Standard & Poor Index 500 stocks declined over almost 53%. Largest one by far, well, not by far, 2002 was fairly close, but before that, much larger than any of the rest of them. How do you want to select stocks? Well, you want to look for stocks that are going to give you a capital gain. That's the difference between what you paid for the stock and what you sell it for. That's known as the capital gains, and there is capital gains tax, so you have to pay attention to those things. Investors should look at a number of things. Blue chip stocks, pretty solid investment. Growth stocks are usually fairly solid as well. Income stocks, those are stocks that you're looking to purchase to get money out of. Usually those are going to be paying you dividends. And then penny stocks are stocks that are just what they say. They're worth pennies. And a lot of people think that that's a good stock to buy because you're not putting out much money and you expect that it's going to return a good dividend. Stock splits simply means that the stock is going to split whatever the company says. The most common is 2 for 1. Now, well, you have to remember this. If you own 10 shares of stock and they're selling for $10 a piece, and all of a sudden that stock is split 2 for 1, most likely, not always, but most likely, you're now going to have 20 shares of stock worth $5. Value still the same. 10 times 10 is 100, 5 times 20 is 100. You just have more shares of stock. Now, the thought of the long term is that stock is going to get back up to $10 again, and now you're going to have double your amount of money. Notice that the last thing, nobody can force anybody to have a stock split. It's just doesn't happen. Many times you will hear a share of stock is worth so much per diluted share. That means that the stock's been split. Buying on the margin, that's when you're buying some of the stock's purchase price from the brokerage firm. Notice here the margin. I want to read this because it's very important to pay attention to this. Margin is the portion of the stock's purchase that the investor has to pay with his or her own money. If the broker calls the margin, the investor has to come up with the money to cover the losses. That's what happened in 1929. A lot of brokers called a margin and people simply couldn't pay. This is a little difficult to see here. I'll see if I can blow this up just a little bit. This is stock price for Microsoft, and it showed what it was trading at after hours trading and before hours trading, and it gives you various what it opened, what it sold for, what its previous high, what its previous close was, and then it just helps you understand that. You can get this. It's pretty hard to find these on a regular basis today. Most newspapers used to print it almost on a daily basis, at least the stocks that were important to them in a specific area. About the only paper that I know that does this on a regular basis is the Wall Street Journal. By the way, you can see this graphically displayed on figure 19.4 at the bottom of page 537. These are the top financial news service research sites, which we're not going to go into. You can read those on your own. If you're going to get into bonds, here's important questions you need to ask. How long do you have to hold the bond until maturity? How can you assess the risk of a particular bond? Know that junk bonds are high risk and they also have high default rates. Yeah, you can make money on junk bonds, but be wary. This is understanding bond quotations, and not something we're going to spend a lot of time on. You can see this at the top of page 539 in figure 19.5. Mutual funds I talked about before. This organization buys stocks and bonds and then sells those securities to the public. It pools investors' money and buys stocks and bonds according to the fund's purpose. The EFT, Exchange Traded Fund, this is the collection of stocks and bonds that are traded on securities exchanges, but are traded more like individual stocks than mutual funds. This gives you some information about learning from a thing called Kachang mutual funds. What mutual funds can learn from Kachang, excuse me. Reform rating systems, give information for free, cut out useless fees, be transparent, and share insights. Get into mutual funds, make sure about the fees in the mutual funds, whether you're going to have to pay what's known as a load, that's upfront money, or you're going to have to pay at the end. This is just another gee whiz slide, the percentage of households owning mutual funds. It's gone from 5% in 1980 to 48% in 2010. This gives you a understanding mutual fund quotations. The company here that's listed is T. Rowe Price. I happen to invest with T. Rowe Price and have been very satisfied with their service. Do not buy anything from T. Rowe Price based on my word. I'm just telling you that somebody that you know has had that experience. Hello? And you can find this on figure 19.7 on page 541. You need to compare investments, and this figure is right below the previous one, figure 19.8, also on page 541. You need to determine the degree of risk, expected income, and the possible growth. It shows you bonds, preferred stock, common stock, mutual funds, and then EFTS. Now, in mutual funds, I want to tell you can get into bonds, and the degree of risk there is much lower than what it says is medium here. And then it talks about possible capital growth. Bonds, you're not going to have much. Preferred stock, you're not going to have much either. But then you're not going to have, there's not much downside to preferred stock. Common stock, and then what you're looking for there. These are our key indicators. The Dow Jones Industrial Average is the one that most people pay attention to, but it is not the best indicator because it is too small. 30 selected industrial stocks. The reason it's widely used is because the calculation is very easy to do. The S&P 500, obviously many more stocks, 400 industrial, 40 financial, 40 public utility, 20 transportation, gives a broader base, and it is probably a more accurate indicator, but again, it's not as easy to calculate. You can see the original Dow 12 and now the current Dow 30, figure 19.9 on page 542. Market turmoil. This is just a little bit of history lesson. October 29, 1929, Black Tuesday. Then we had October, notice all these things in October. October 1987, the market went down precipitously, 22% of its value in one day. actually more than the stock market drop in 1929. But that was more pervasive in 29 due to a number of other issues. October 97, fear of Asian crisis, and there was an Asian crisis, by the way. And then here's the 2000s. We had the tech bubble burst in between 2000 and 2002, and then of course what happened in late 2007, beginning, and then mushroomed, as I like to say, in 2008. Again, a little bit of a history lesson. Wall Street, the Wall Street of now, transportation, and what it was then and what it is today. This is something we have to be concerned, but because of the market is electronic, a lot of this stuff is done without investors being involved all the time. The programs are set up by computer. When a price reaches a certain level, there's a sell order that's generated, or conversely, a buy order that's generated. So this is a problem, and it's a continuing problem. Analysts believe this is part of what caused the problem in '87. We've had a couple silly little, not silly, we've had a couple glitches that were not fully explained in the last few years. And so it does have something we do have to be concerned about. Well, here's the question that's asked, and I don't think it really has a good answer. Who was at blame for the economic crisis? Wall Street certainly had people there who were greedy. They were issuing investment opportunities, investment instruments that nobody really even understood. SEC probably did some things it shouldn't have done. We relaxed through an act of Congress back in the late 1990s. Relaxed the wall between traditional banks and other financial institutions. Let them sort of swap back and forth, and so we didn't really have good control. We've done some things now that puts them in control, but the investors are continually arguing, saying the rules are too onerous. Well, here's the thing to think about. Maybe they're too onerous for those folks, but are they going to protect us on Main Street? That's what we have to be. That's what we have to look out for. And you know, the people who are greedy are going to continue to be greedy. But we have to protect. At least I think we do. The small person. So have to be careful about that. And of course, there are ways to clean up Wall Street. Dodd-Frank, that's part of what they're complaining about now. But it does give the government a little bit more power. And we now have a independent consumer financial protection agency within the Federal Reserve, and complained about right along. But hopefully, these people are there as watchdogs that can protect the individual investor from greedy people who are really trying to make more money, and in many cases don't need to make more money. Well, a little bit long here tonight for the first hour. That brings us to the end. We are now at 5:56. So I would like to take a break to 6:01. We're just going to make a five-minute break tonight, and then we'll be back to check chapter 20, which is the last one, money and the Federal Reserve Bank. So thank you. Please come back at 6:01. All right, we're back, chapter 20, our last one for this evening. Next week, remember, we'll be back to discuss bonus chapters A, C, and D at the same time. Money, financial institutions, and the Federal Reserve. Our learning goals for this chapter explain what money is and what makes it useful. Look at the Federal Reserve and how it controls money. Look at the history of banking and the Federal Reserve System, and classify the various institutions in the U.S. banking system. And then finally, trace the causes of the banking crisis that started in 2008. I really think it started late 2007. Describe how technology helps us and helps banking become more efficient. And then we're going to evaluate the role and importance of the international banking, specifically the World Bank and the International Monetary Fund. So the first question we ask here is, what is money? Interesting concept. We all know what money is. We have it. But money is anything that people generally accept as payment for goods and services. So it can be any number of things. In Holland, when it was called Holland back in the 16th century, it was tulip bulbs. And so it's been various and sundry other things over a period of years. Barter is something that is entirely different than money. You hear people trading, trading goods and services for other goods and services. But a barter, and that's what a barter is, a barter does not have to be an equal trade. The one that I like best is one that a student gave me a few years ago. I was going around the classroom and I was saying, okay, what's barter? Give me an explanation of barter, or maybe you've done barter. And we got a number of definitions. And she said, well, here's what I did. I needed some furniture moved, and I knew a man that owned a truck. And I said, if you'll move my furniture for me, I'll cook you a chicken dinner. And so they made a deal, and that was a barter. Was it an equal trade? Probably not. But each person got something of value. So that was a barter. Here are the 5 standards of money. It has to be portable, divisible, stable, durable, and it has to be unique. In some way, it sets itself apart from something else. Now, here we're going to talk about money that most of us don't think about. And this talks about the money supply, specifically the money supply in the United States. This is the amount of money that the Federal Reserve makes available for people on a daily basis, referred to in 3 categories: M1, M2, and M3. Now think of M1 money as being liquid. What that means by liquid here, I mean something that can be gotten to very quickly. Notice what it talks about: checking accounts, paper money, traveler's checks. All those things can be gotten to very quickly and be turned into coin, if you want to, on a very, very, very routine basis. Now, M2 money is everything that's in M1 and money that may take a little bit more time to get to, such as savings accounts, certificates of deposit, etc., and mutual funds. Okay. By the way, M1 I didn't mention, it does include coins. And then M3 is M2 plus deposits, big deposits, like institutional money market funds. This is just a gee whiz slide, and it shows you paper money printed in billions of dollars in the United States. And again, it's not something we're going to spend a lot of time on. And this one also, we're not going to spend a lot of time on. How long does paper money last? So interestingly enough, the $5 and $10 bills last less amount of time than a dollar bill does. These are money milestones. Here again, this is a little bit of a history lesson. See here that the United States Congress in 1956 passed the minimum wage of $1 an hour. Now, there were organizations that did not have to adhere to that $1 an hour. And then up to a $1 billion stadium built in London, Wembley Stadium. I don't remember whether Wembley was rebuilt or a new stadium or it was refurbished. Wembley Stadium is a stadium that's been around in England for many years. This is another little bit of a history lesson here. Money facts, which you might not know. Each penny cost actually $1.06. Excuse me, cost 1.6 cents to make. Nickel cost 6 cents to make. 2/3 of all U.S. $100 bills are outside the United States. And the last one I think is very interesting. 90% of paper money has traces of cocaine. Now, money has to be traded worldwide. It has to be accepted worldwide, traded to facilitate exchange of foreign currencies. So we need to think about a couple of things. What helps us in the United States? Well, if the value of the dollar in international monetary trading markets is less than $1, it means that if you were buying goods and services outside the United States, you could buy fewer of them. Normally speaking, it doesn't make much difference to the United States. Within the United States, a dollar should still be buying $1 worth of goods or services. When you go outside the United States, it won't. A rising dollar means that you can buy more goods and services with your dollar. Usually refers to imported goods. Now, if we're remember here, we're talking exchanging money globally. And that's why I say here within the United States, the rising or lowering value of the dollar doesn't make much difference to us. But if you go overseas, it will. Now, if you buy foreign goods here, and our dollar is relatively weak against a foreign currency like the euro or the pound, then you're going to be able to not buy as much the foreign goods and services as you wanted to. If it's rising, it's just the reverse. And this last thing, what makes the dollar rise and fall is the position of the U.S. economy relative to other global economies and also people in the market. People who speculate in the market, money speculators, money traders who speculate, and they have a lot to do with what the value of the dollar is. That many times that's much different than what the official trade rate is, or the official rate is. If the dollar falls, we're going to have more people. Overseas demand for the U.S. products is going to go up because they're going to be able to buy it. Their currency is worth more. And of course, if there's a favorable exchange rate, U.S. companies can increase their profits in foreign markets. Now that means if our dollar is worth less over there. And then, of course, by converse, then we get more people come over here to the United States to spend money as tourists. Now we're going to talk a little bit here about the Federal Reserve. These are the major parts of the Federal Reserve. It has a board of governors, the Open Market Committee, 12 regional Federal Reserve banks, 3 advisory councils, and then the member banks of the system. The Federal Reserve regional banks are listed in figure 20.1 on page 558. And they're shown here as well. We're not going to pay a lot of attention to that or spend a lot of time on that. Now, here's what the Fed has to do. These are things that it does. It has its basic tool to manage the money supply. Tools, is the reserve requirement. We're going to go through these and we'll come back to them. The open market operations and then the discount rate. The reserve requirement is the amount of money or percentage commercial banks have to keep on hand or in non-interest bearing deposits at the local Federal Reserve banks. So look at that as a buffer, a cushion that they can get that money if they need to have it, and it helps keep their equilibrium where it ought to be. The open market operation is buying and selling of bonds, government bonds. And the discount rate, pardon me, is the interest rate the Fed charges for loans to member banks. This is the check clearing process that the Fed goes through. That can be graphically seen on page 560, figure 20.3. And I'm going to try to blow this up for you just a little bit. Of course, you can look in your text along with me. And here we have the what the farmer here does in Quince Orchard, Maryland. So he's a buyer. The seller is a tractor dealer in Austin, Texas. Goes to the transaction goes to a local bank in Austin, Federal Reserve in Dallas, and Federal Reserve in Richmond. Goes to the local bank in Quince Orchard, etc. So that's how that goes. But we don't see as much of this today because many checks are being taken care of. There's so many more people who pay online that we don't have as much check clearing as we used to have. Of course, we still have that. It's still around. It's still going to be around. But well, I shouldn't say it's still going to be. It's going to be around for a while. But we can expect that's going to change over a period of years. The Federal Reserve was established in 1907 due to a cash shortage problem. Many people say that cash shortage was engineered by J.P. Morgan, rather huge person in the financial world of the United States at the turn of the 20th century, and actually a little bit before that. And Morgan Chase is a bank that bears his name, and J.P. Morgan was quite a financier. In 1913, under the Federal Reserve Act, all federally chartered banks had to join the Federal Reserve. Now, notice that it's federally chartered. There are still bank-chartered banks that do not have to do that. I had an experience when I was in the military. I was at a school in El Paso, Texas. And I opened a bank account just so I could, in case I needed some money. My wife couldn't send me money for some reason, or I needed it before I could get a hold of her. But I had to do business at that branch bank only. I could not go to another bank. That's different from a federally chartered bank when you can go to banks all the way around. This is a largest bank failures in the United States. Notice they're almost all recently, although we do have a federal savings and loan in here. IndyMac Bank, 2008. I had a student in one of my courses here at Union. She and her husband lost a great deal of money in that failure. So these are some things that are very serious, and they certainly impact many people, and more than just the investors. U.S. banking system made up of commercial banks, savings and loans, credit unions, and then non-banks. Commercial banks, what most of us know, they are in business to make a profit. They lend money and charge interest for lending money, which most people do when they're lending money out. They're using your money as a depositor to make those loans, and in turn, they pay you an interest on the money that you have deposited in the bank. So what it says here, they get money from us, the individual investor. Well, not investor, individual. We don't think of people putting money in bank as being an investor, but in fact they are, especially if they're into some type of savings or certificates of deposit, things of that nature. And then they also have it from corporations as well, checking, savings accounts, etc., money markets, whatever. And then those funds are available to make loans. Now, of course, there's the Federal Reserve requirement, so that they cannot use that. They have to keep that there. But they use that other money to make banks. And then, of course, there are two types of customers: those that deposit money and those that ask for loans. Or, as a friend of mine likes to say, he doesn't go to the loan. He says that if he goes to a bank to borrow money, he says, I shouldn't, he goes and says, terrible language. He says, I'm here to buy some money. Now, these are commercial bank services. We have demand deposits, time deposits, and certificates of deposit, excuse me. Time deposits, notice that technical name given for checking account. Money is available on demand. That's why it's called a demand. You can go and say, I want that money. A time deposit is it's a savings account. And notice that the bank can say to you, Mr. or Miss Depositor, you have to tell us ahead of time that you're going to take the money out. And then a certificate of deposit, again, that's a savings account that earns money to be delivered at the certificate's maturity date plus interest. This is just a story here about banking and social media, which I'm not going to go into. Social media and business, you can find that in the text. And this is making an ethical decision, what to tell a teller. Again, interesting scenario, and I commend you to read it, but it's not something that you have to. Savings and loans, different than banks. But they are set up like banks, that they do take deposits. Some do have checking accounts, that probably all of them do, and they make home loans. Now, that was the primary reason for savings and loans to be in business. That was to offer home loans. That was their original purpose. You can see this here in the second bullet. Credit unions operate like banks, but they're only open to their members. Notice there that they're nonprofit, owned by members. It's a financial cooperative. We talked about cooperatives early on in the course, but it's the same type thing. They usually offer a full variety of banking services to their members. Notice, to their members. So they are, for the most part, are precluded from going outside their boundaries. Some of those boundaries have been loosened a little bit, so they're not quite as onerous, if you will, as they had been. But certainly, they still have boundaries that they can't go out. Notice here they're nonprofits and they are exempt from income tax. Non-banks. These are life insurance companies, pension funds, brokerage firms, etc. They don't accept deposits, but they do offer many banking services. This is the rise of the non-bank. About a quarter of us don't have bank accounts. Interesting. Online banking. We know that has really taken hold. Free identity theft protection, free credit score monitoring, personal financial management, instant messaging, et cetera, et cetera, et cetera. We find that this is what I would call the wave of the future. Now, depositors want their money protected. And we have three things here. We have the Federal Deposit Insurance Corporation, the Savings and Loan Association Insurance Fund, and the National Credit Union Administration. These are independent agencies of the federal government, and they insure bank deposits to $250,000. Credit union does the same thing. And I believe, I'm not 100% certain, that the Savings and Loan does the same thing. We know what a smart card is. It's a combination of a debit card, credit card, phone card, etc. Here are other transactions that banks can help you with. Letter of credit, the promise by the bank to pay the seller a certain amount of money if conditions are met. Banker's acceptance, it's a promise the bank will pay some specified amount at a particular time. And the money exchange allows companies to go to a bank and exchange currencies to use in a particular country, dollars to euros, et cetera, et cetera. I will tell you that if you're going to do this and you go to a local bank that does this, you will not pay the official rate. You will pay more than the official rate if you want to buy euros, or if you are going to sell them. You won't pay the official rate because the bank is going to make some money on that transaction. Now, here are two large lending institutions that do have some impact on third world countries. There's a lot of concern as about whether these folks actually do the things that they're set up to do. Some people think that they put too many conditions on developing countries, but they do a fair job of holding down corruption and things of that nature. World Bank lends most of its money to less developed countries to help them improve their productivity and quality of life, et cetera, et cetera. International Monetary Fund, fosters cooperative monetary policies that help stabilize the exchange of one national currency for another. And there's about 185 companies in the International Monetary Fund. And these are some new issues that are facing the World Bank and the Monetary Fund obviously there's been a crisis going on in Europe for some period of time. Japan recovering from the earthquake and tsunami several years ago. We know that there's continuing disruption in the Middle East. It seems like that's an ongoing scenario. China and Brazil are having problems. Brazil is having a huge problem down there right now. It's supposed to hold the what is going to host the 2014 is going to hold the World Cup for soccer this year. 2014 is scheduled to hold the Summer Olympics in 2016, but it's having some real problems. And then poor nations have difficulties with rising food prices, and IMF and the World Bank are trying to come together to grapple with that, to get to that, to add to help people out. Well, chapter 20 is a very small chapter. There's not as much to cover, or much time to spend as we spent in chapter 19. So we are finished for this evening. We spent about an hour and a half here, roughly, of getting through this. I apologize for my technical issues. I've got those straightened out. Most of them were mine, but I was thrown a curve. I couldn't find an icon to get in, and that caused me a little problems. We will be back here next week to we'll be back here next week to cover bonus chapters A, C, and D. Bonus chapter A, working within the legal environment. Bonus chapter C, managing risk, and then bonus chapter D, managing personal finance. So I thank you for your attention and good night.